Hi, I'm Joe Urwitz. I'm a partner at McDermott Will Emery. There are a lot of things companies can do to help save themselves and executives money. One thing that's very, very important for public companies to have, and really even for private companies too, is to have a good deferred compensation plan in place. One thing that public companies need to do is, if they intend to pay those executives over $1 million, make sure that their performance criteria meet with that which is required in the code. The code generally limits the ability of companies to deduct compensation in excess of $1 million to executives. So companies that don't do that properly are going to lose those tax deductions. And there are a whole lot of hoops that companies have to jump through. Companies have to make sure that shareholders approve of whatever performance objectives they set up. Companies have to have shareholders reapprove those every 5 years. Companies have to certify the performance criteria. There are limits on companies' ability to adjust the performance criteria for events that might affect executives' ability to hit those, such as spin-offs and recapitalizations. So there are an awful lot of rules to jump through on this, but companies that don't do it can face disastrous tax consequences. One of the things that determines how much excise tax is assessed is the executive's compensation in years prior to the change in control. So one technique that we've seen companies use is for change in control events where the agreement to enter into the change in control is signed in 1 year and the change in control doesn't happen until the next year, is to have executives exercise non-qualified stock options, which gives them a huge amount of taxable income, depending, of course, on how many options they have.